Beyond the stock, what are some common news events or happenings in a publicly traded company that signal the company is undervalued, or could see a future rise in stock price? Please give me a list of 10 such events with a 5 or 6 sentence explanation for each. 1. Insider buying by executives or directors. When company insiders, especially CEOs, CFOs, or board members buy large amounts of their own stock with personal money, it can be a powerful signal of confidence. Insiders already know the company's internal performance, pipeline, and challenges better than outside investors. If they choose to purchase shares instead of selling or taking compensation in stock, it often indicates they believe the market price is too low. Multiple insiders buying at the same time can be an even stronger indicator. Investors frequently track insider filings, like SEC Form 4 in the US. While not guaranteed, insider buying historically correlates with periods of undervaluation in many companies. 2. Major share buyback programs. A large share repurchase announcement can signal that management believes the stock is undervalued. By buying back shares, the company reduces the total share count, which increases earnings per share, EPS. This often makes the stock more attractive to investors and can lead to price appreciation. Buybacks also show that the company has excess cash and confidence in its future. If the buyback represents a significant percentage of market capitalization, it can have a meaningful impact on supply and demand for the stock. In many cases, markets react positively over time to sustain buyback programs. 3. Activist investor involvement. When a well-known activist investor takes a stake in a company, it often signals that they believe the company is undervalued or poorly managed. Activists typically push for changes such as cost reductions, asset sales, leadership changes, or share buybacks. These changes are designed to unlock shareholder value that the market has overlooked. The presence of an activist can also bring attention to the stock from other institutional investors. Activist campaigns frequently trigger strategic reviews or restructuring initiatives. While not always successful, activism has historically driven significant share price increases in many cases. 4. Spin-off announcements. A spin-off occurs when a company separates a division into a new independent public company. These situations can create value because the separated businesses may be easier for investors to analyze and value individually. Often, one or both companies were previously undervalued inside a larger conglomerate structure. Spin-offs can also allow management teams to focus on their specific business strategies. Additionally, institutional investors sometimes sell spin-off shares automatically due to mandate restrictions, temporarily depressing prices. This forced selling can create buying opportunities for investors. 5. Debt reduction or balance sheet repair. If a company announces a plan to significantly reduce debt, refinance expensive loans, or strengthen its balance sheet, it can signal improving financial health. Companies burdened by debt often trade at lower valuations due to perceived risk. When that risk begins to decline, the market may re-rate the stock upward. Debt reduction also improves profitability because interest expenses decrease. In some cases, companies sell non-core assets to pay down debt, which can unlock hidden value. As financial stability improves, institutional investors who previously avoided the stock may start buying it. 6. New leadership or management turnaround. The appointment of a respected CEO or management team can be a major catalyst. Markets often lose confidence in companies due to poor leadership or strategic mistakes. When a new executive with a strong track record arrives, investors may expect operational improvements. Turnaround leaders often restructure operations, reduce costs, and refocus the business strategy. This can dramatically improve profitability over time. In many historical cases, leadership changes have marked the beginning of long-term stock recoveries. 7. Strategic partnerships or major contracts. Announcements of significant partnerships, supply agreements, or long-term contracts can signal future revenue growth. These agreements can validate a company's technology, products, or services. For smaller or mid-sized companies especially, a partnership with a large industry player can dramatically change investor perception. Long-term contracts also provide revenue visibility, which reduces uncertainty. If the market underestimates the importance of the deal, the stock may remain undervalued initially. Over time, as the revenue materializes, the stock often reprices upward. 8. Asset sales or unlocking hidden value. Some companies own valuable assets that are not fully reflected in their stock price. These might include real estate, patents, subsidiaries, or resource reserves. When a company sells or monetizes such assets, it can reveal value that investors had not properly priced. Asset sales can also provide large cash inflows that strengthen the balance sheet or fund growth. In some cases, investors realize that the remaining business alone justifies the entire market valuation. These types of events can lead to sudden re-evaluation of the company's worth. 9. Industry downturn despite strong company fundamentals. Sometimes an entire industry falls out of favor with investors due to macroeconomic concerns or cyclical downturns. Even well-run companies with strong balance sheets can see their share prices decline in these periods. If the company continues performing well despite industry pessimism, it may become undervalued. Investors who recognize the company's resilience may see an opportunity before the broader market does. When industry sentiment eventually improves, these stronger companies often recover faster. Historically, some of the best long-term investments occur during sector-wide pessimism. 10. Regulatory approval or resolution of uncertainty. Stocks often trade at depressed valuations when there is uncertainty surrounding regulation, lawsuits, or government approvals. Examples include drug approvals, mining permits, environmental rulings, or major legal cases. Once the uncertainty is resolved favorably, the perceived risk drops dramatically. This can lead to rapid revaluation of the company by investors. The market often prices in worst-case scenarios before decisions are made. When outcomes are better than feared, the stock price can rise significantly. Key insight. Many of these events work because they reduce uncertainty or reveal value the market has overlooked. Markets often misprice companies temporarily when information is incomplete, misunderstood, or ignored. If you'd like, I can also show you 10 specific real-world examples where these signals happened and the stock later rose significantly. Some are quite famous cases in investing history.